Hi, everybody. This is Simon Black. Again, this is now podcast episode number 3. And just as, excuse me, last week, I had the pleasure to be joined by my friend Peter Schiff, with the two of us stranded away at sea together. This week, I actually am with Jim Rickards, another esteemed colleague who is coming out now with his next book, The Death of Money. That's the title right now, right, Jim?
That's right, Simon. Nice to be with you. The Death of Money is the title, but it has a cheery subtitle. It's The Death of Money, the Coming Collapse of the International Monetary System. So something to brighten everyone's day. But seriously, it is an analysis of how the international monetary system is heading for collapse, and it talks about how that will take place, so the dynamics of it, so investors can kind of see it coming, and then what will replace it, so investors can prepare for that world. So I hope your listeners have a chance to order it and enjoy it.
I have to really recommend to everybody who hasn't already read Currency Wars. I would really recommend that folks go out and read that book. I think it is one of the most insightful books on the financial system that's out there. And of course, I get absolutely nothing for saying that. I truly believe that to be the case. And the reason why is because I'm going to embarrass you a little bit, Jim, but and I've mentioned this to a lot of people before. But you're one of the only sound people out there who really understands that this whole concept of just conjuring money out of thin air is obviously not the path to prosperity. But at the same time, you're sort of on the inside. I mean, you have conversations with central bankers, with folks at the Fed, very, very senior people within the administration, within the banking system, within the Federal Reserve System, and it's very unusual for somebody in your position who has that kind of access to those people to also simultaneously kind of get it, because everybody else is sort of drinking the Kool-Aid, and you're in a very unique position where you understand that again, this just isn't the path to prosperity.
I think that's right, Simon. I'm kind of in an unusual position in the following sense. A lot of people know that my background is as a lawyer. Before I did a lot more in economic analysis and economics, but before I went to law school, I got a graduate degree in international economics, and I went to the School of Advanced International Studies in Washington, part of the Johns Hopkins University. But that school is, in effect, boot camp for the IMF. My fellow students, I happened to go to work for Citibank. I started my career in New York at Citibank as their International Tax Counsel. But a lot of my classmates went straight to the IMF. It was training ground for the IMF. Tim Geithner went to the same school. Secretary Geithner went to School of Advanced International Studies, and Wolf Blitzer, a lot of other distinguished alumni, and of course Geithner went to the IMF. So I was formally trained in the international monetary system. Of course, spent my whole career as a banker and lawyer in international finance in different ways. So I'm very immersed in that, and along the way, I was general counsel, one of the primary dealers. Just so the listeners know what a primary dealer is, when the Fed prints money or conducts what they call the market operations or monetary policy, they do it by either buying securities, which is quantitative easing, or sometimes they tighten and they sell securities. Well, when you buy and sell securities, you need a counterparty. You can't do it in a vacuum. You need someone to trade with. The Fed has an approved list. They will only trade with certain firms, not any firm that comes along. And right now there are about 20 of them. The number varies, but the people on that list are the primary dealers. Well, I was chief credit officer and general counsel of one of the primary dealers. So I had many meetings at the Fed, and then later on my firm was acquired by a bank holding company, and then I had meetings with the Fed in Washington, made quite a few good friends there, and I do consulting for the Pentagon and the national security community. So I do have a lot of links into that, and I've been invited down by the Treasury, the Office of Financial Research, and other agencies focused on systemic risk, Financial Stability Oversight Committee, to brief them. So I'm kind of in a strange position in the sense that I've got formal training and a lot of contacts in the government, a lot of contacts in what you might call the establishment, but at the same time, I'm very critical of that group. Not personally; these are all sort of good people, but I'm critical of the models, I'm critical of the method, I'm critical of the failures, and I'm also deeply troubled that the victims in this crash are going to be everyday people. In other words, the hedge fund guys always do fine. The elites always do fine. Some smart people who get gold, they do fine. The people who don't do fine are people who rely on the government. So savers, people with insurance policies, annuities, retirement money, they're the ones who get wiped out. And so I'm trying to basically take the expert knowledge I have and the high-level context I have and basically provide a warning or a message to everyday investors.
What do you think is the most important thing that, let's say, if you could just sort of broadcast a message to the entire world, to the average guy out there, what do you think is the most important thing that they need to understand?
They need to understand that the next collapse will be bigger than the central banks. That was not true the last time. In 2008, we had a major financial catastrophe. We know that Bear Stearns and Lehman Brothers failed. We know that AIG failed. But candidly, Morgan Stanley was days away from failure. Goldman Sachs would have been right behind that. Citibank and Bank of America right behind that. Maybe JP Morgan would have survived, but maybe not. Maybe they all would have gone. Those dominoes were falling. Why did they not fall? Why did they not all fall? Some of them did, but some didn't. That dynamic, as I call it, was truncated by government intervention. We know about the money printing. We know the Fed has printed almost $4 trillion in the last 5 years. That's well known. But less well known are the tens of trillions of dollars of swaps that the Fed did with the European central banks. Now think about European banks. They were in the same kind of trouble, and they owed dollar liabilities. But their lender of last resort is the European Central Bank, or the ECB. Well, the ECB can print euros, but they can't print dollars. So if you're a bank in Europe and you need dollars and your central bank, your lender of last resort, can't print dollars, where do you get them? Well, what happened was the ECB did swaps with the Fed. So the ECB gave the Fed euros, which they printed, and the Fed gave the ECB dollars, which the Fed printed, and then the ECB took the dollars and gave them to the banks. So the Fed wasn't just propping up the U.S., they were propping up the whole world, and it wasn't just the money printing and the swaps. They guaranteed all the money market funds in America, and they guaranteed all the bank deposits in America. So this was a massive, it's tens and scores of trillions of dollars to stop the dominoes from falling, to stop the system from collapse. The problem is that they're out of powder. It's like if you have 6 shots in your gun and you fire 6 shots, you still have the gun, but you got no bullets. Now, the Fed's balance sheet is $4 trillion today, as I mentioned, up from $800 billion. What if there's a crisis tomorrow? What are they going to do? Take it to $8 trillion, $10 trillion? They can't. They're at the limit. They're leveraged 80 to 1. They're insolvent on a mark-to-market basis, and that's not a guess. I actually had a conversation with a member of the Federal Open Market Committee, and she admitted to me privately that on a mark-to-market basis, the Fed's insolvent. Now, the Fed doesn't actually mark their balance sheet to market. They hold securities at historic cost. So those losses are hidden. But if the Fed were a hedge fund, and I think of it as a hedge fund, it's leveraged 80 to 1 with a lot of duration risk, asset liability maturity mismatch, and insolvent or broke on a mark-to-market basis. If the Fed were a hedge fund, they would have been out of business a long time ago. So the next time it happens, and it'll be bigger than the last time, and I can explain why, the Fed's not going to be able to bail it out. It's going to be bigger than the Fed. By the way, the People's Bank of China in the last 4 years has printed more money than the Fed. And the Bank of Japan and the Bank of England, all the central banks are tapped out. So the only clean balance sheet left in the world is the IMF. The Fed's leveraged about 80 to 1, as I mentioned. The IMF is only leveraged 3 to 1. And they can print money. A lot of people don't understand this, but, the Fed has a printing press. They can print dollars. The IMF has a printing press. They can print what are called SDRs, special drawing rights, or SDRs. It sounds geeky and funny, and people don't understand it, but it's just world money. It's actually not that hard to understand. It's world money. It's printed, comes out of thin air, just like dollars or euros, and they can do it, and they have done it. It's not new. They started printing SDRs in 1969 when there was a run on gold. They printed more SDRs in the late 70s when it looked like the dollar was close to collapse at that time. Dollar lost 50% of its purchasing power between 77 and 81 in that 5-year period. Then you had 30 years when no SDRs were printed from about 1980 to 2009. Well, that was the period of the stable dollar, the so-called king dollar period. You didn't need them. The people trusted the dollar. But beginning in 2010, we started the currency wars. We're trying to trash the dollar. When confidence is lost, the IMF will rush in. But the difference this time is that, remember, China and Russia and the BRICS and the rest of the G20 are part of the IMF. This is not totally controlled by the U.S., and so they're going to insist that these SDRs replace the dollars, and that's the end of the dollar as the world reserve currency with major inflationary implications. So my message to investors is the collapse is coming. It'll be bigger than the Fed, and the answer is going to be SDRs, and you're not going to like it.
Yeah, these are all really important points. You mentioned the Chinese, of course. There's so many dominoes that are falling in China right now. All of the corporate bond defaults that are occurring, the massive over-leveraging that's happening there. You mentioned obviously the People's Bank of China, which has printed more money even than the Fed, the Bank of Japan, and of course the Federal Reserve, which, as you mentioned, on a mark-to-market basis is insolvent. They just released their annual report and showed that they have a 50 some odd $billion unrealized capital unrealized loss, which is essentially the entirety of the Fed's equity. The Fed has, if you actually count the losses, say, oh, we'll never realize those losses, we'll just hold forever. And you count the unrealized losses, the Fed is sitting on $1 billion of equity on $4 trillion in assets, 4-point-something trillion dollars in assets. I mean, it's just an unbelievable level of leveraging. And you're right. I mean, at the last crisis, everything was sort of smothered by the central banks, particularly the Fed. Then you get into a crisis where the Federal Reserve isn't in a position to do anything anymore, and then you only have what's the lender of last resort to the Federal Reserve? You're in a position where it has to be the IMF. That's about the only thing.
It was the IMF, and that's a very good point, Simon. You know, people have used the phrase "kick the can down the road" ad nauseum. I'm sick of hearing it, but the way I think of it, we're not kicking the can down the road. We're kicking the can upstairs. And in other words, in 2008, you had a private debt crisis. The private debt was papered over with public debt, deficit spending and money printing, okay? So now we're heading for a public debt, a sovereign debt crisis. All these sovereigns are going to default. And then who's on top of that? Who's in the penthouse, in other words? Well, the penthouse is the IMF, and they do still have a clean balance sheet. So, but there's a price involved. If you're going to bail out the world with SDRs, which they can do, you're going to play by their rules. And their rules are unaccountable. That's not an elected body. There are no public officials. There's no parliament. You've got kings, dictators, communists. I mean, that's who the IMF is when you look at the membership of their board. And they will bail out the world with SDRs, but they're going to do it on their terms. China's going to say, well, fine, we'll vote in favor of printing some SDRs, but the dollar is done as the reserve currency. From now on, the price of oil will be in SDRs, the financial statements of the major financial corporations, settlement of balance of payments between countries. Now, bear in mind, we'll still have dollars. I mean, we'll walk around with dollars. We go out for a drink or something. We'll tip the bartender in dollars, but it'll be a local currency like the Turkish lira or the Mexican peso. It just won't be important in the international monetary system. And by printing all these SDRs, of course, it's highly inflationary. People won't know where the inflation's coming from. People will blame the Fed, and the Fed will say, hey, it's not us. It's those IMF guys, over on G Street or wherever they are in Washington. And so there's going to be a lack of accountability, lack of transparency, hyperinflation. No one will know where it's coming from, and the dollar will be done. The dollar will be like the Mexican peso. We'll use it locally, but it won't be important internationally.
Right. It'll just be any other currency, and that's the funny thing. I mean, you mentioned the incredible power that these agencies have. I mean, even the Federal Reserve right now, they can just conjure money out of thin air. And these people aren't elected. A lot of the members of the Fed, they're appointed by banks. But I mean, then we get to a point where you've got the IMF that is this supranational body that can conjure SDRs out of thin air, and we get into a position where now these are the people that become responsible for the global financial system. What's interesting is you've probably heard is that there's legislation in the United States. Obviously, right now, the United States is in this relatively large position in terms of the voting power of the IMF. And there's a lot of countries that are saying, hey, this is an antiquated model. The U.S. shouldn't have all these rights. European Union shouldn't have all these voting rights. We need to reallocate the voting rights. And the United States has been very intransigent in giving up so much influence, and they've really been delaying the legislation to sort of remodel the IMF structure in a way. And that's something I think the more they delay that, the more it's just going to be forced upon them. They can sort of be part of the conversation, or you can be left out of the conversation.
Well, that's a very powerful point, Simon. You're exactly right. And this is something, I'm sure you're familiar with it. Naomi Klein wrote a book on it called The Shock Doctrine. And the shock doctrine says you create a shock somewhere. It could be a war, could be a financial collapse, whatever it is. And you use the shock to pursue a hidden agenda that has nothing to do with the shock itself. For example, 9/11 was used to pass the Patriot Act, which is now being used to spy on Americans, right? That's an example. Now, the Ukrainian crisis that's going on right now with Crimea and Russia and the United States and the confrontation there, well, guess what? Ukraine is broke. Putin has taken over Crimea. He's threatening eastern Ukraine, so the United States and Europe want to rescue western Ukraine. Well, to rescue Western Ukraine, you're going to need like $20 billion. You're going to need an enormous amount of money. So Christine Lagarde, the head of the IMF, is saying, well, if you want us, meaning the IMF, to rescue Ukraine, we want something from you, and there's legislation pending. The United States has never funded the $100 billion that we promised at the G20 summit in 2009. President Obama made a promise, and we're committed to it. That was passed in legislation, but we've never actually funded it. Now what the IMF wants to do, they want to take that funding, which would be a form of debt, and turn it into equity, what they call it quotas. That's just jargon for their equity. Well, that needs new legislation. So guess what? The legislation to authorize aid for the Ukraine included in it other legislation that would give this additional money and this additional power to the IMF. Now, the Republicans stood up and opposed it. Actually, they didn't oppose it. What they said is, we'll vote for it, but we want something back in terms of the IRS Tea Party scandal. So typical Washington politics, and nothing got done. But this has been on the table for 5 years. The IMF has not given up on it, and their IMF supporters in the U.S. Congress have not given up on it. But again, good example, the shock doctrine. They're using the Ukrainian crisis to pass non-related legislation that would turn U.S. commitments into further equity for the IMF and enhance the power of the IMF. And China's saying, we're not giving you any more money unless we get more votes. Well, where are those votes going to come from? I mean, you only have 100% of the votes. So if China is supposed to go from, let's say, 3% to 5%, somebody else has to lose 2 percentage points. And they're looking at Belgium and the Netherlands and some of these other countries. So there's a lot going on behind the scenes. But I talk about this in the book. This is all in Chapter 8 of The Death of Money. Chapter 8 is all about the IMF. I call it Central Bank of the World. Chapter 9 is all about gold. Chapter 11 is about the end game. So there's a lot there that I hope the readers enjoy that goes into what we're discussing, with a lot of documentation. I actually found a letter from the president that was using gold as a source of strength, where you actually had President Obama signing a letter saying we can be very confident in making this loan because it's backed by gold. I found that curious that the president's trying to go on a gold standard. But when you really dig in the record, there's some interesting stuff.
Yeah, absolutely. And this book is, as you say, in a way, is sort of a prequel and a sequel to Currency Wars. Currency Wars obviously explains everything that was going on in the financial system in the early days of the crisis, when I think it was the Brazilian finance minister that coined the term currency wars, when there was this competitive devaluation, seeing which country could outprint whichever country the fastest. And again, obviously that's not the path to prosperity. When you go out of your way trying to devalue your currency from, and do that in a faster rate than every other country that's devaluing its currency, that's generally not the way that you create prosperity in the world. And now your new book takes that obviously a step further and says, hey, look, there's obvious consequences from this, and here's what we can sort of see happening. And that's the interesting thing about this is obviously you're such a data-driven person. This isn't crazy conspiracy theory. This is rational analysis based on publicly available data.
Well, that's right. The book actually has 300 footnotes and about 30 pages of sources and various quotes with attribution and conversations with some of the most powerful people in the world where I use exact quotes. So it's very thoroughly researched. Right. The thing is, Simon, anybody can say, the Fed's printing too much money, the world's coming to an end. Well, I might even agree with that. But if that's all you have to say, I'm not very impressed with the level of analysis. So what I try to do for the reader is, okay, I may have some dire warnings like others, but I have a lot more detail, a lot more analysis, a lot more sort of what I call dynamic systems analysis to explain how these things play out, and a lot more of where the system is going based on history and based on my sourcing. And what it does, it lets the reader judge for themselves. They don't just have to have a binary reaction to a cataclysmic statement. They can read the evidence and make up their own minds. And that's all I'm trying to do for the readers, just lay it out there and let people decide for themselves.
Yeah, myself as I view myself obviously as a very data-driven person, very rational historic analysis, the data analysis, and so I have a lot of respect for you as well as a very data-driven person. And I agree, the conclusions, I think, the trends, everything is very clear. And of course, my whole view and the view that we constantly try to get people to understand at Sovereign Man is, this is the trend. Here's the data. Even if you deny all this, and even if you say there's no way that could possibly happen, of course, every great civilization has always said it's never going to happen. It can never happen here. Even if that's the case, and even if there are no consequences to huge debts and printing money, etc., you're not going to be worse off for having a plan B. You're not going to be worse off for being aware of it. You're not going to be worse off for educating yourself and finding out what the actual data is and what the situation is and what the implications are. And again, formulating a plan B. You're not going to be worse off for that, because if you ever get into a position where plan B becomes plan A, then that's going to have been the smartest thing you've ever done. But even if nothing happens, then you're not going to be worse off for it.
That's right, and people need to think about it now, Simon. The question I get most frequently is, okay, Jim, I hear what you're saying. I agree with the analysis. Something bad is going to happen, and I want you to tell me when it's going to happen, because I want to enjoy this stock market bubble right up until the day before, and then the day it's going to happen, I'm so smart, I'm going to sell all my stocks that day and wake up the next morning and buy gold, and I'll be fine. Of course, that's nonsense. That's not the way the world works. When this catastrophic event happens, we won't see it coming. You know, a lot of people say, oh, gee, Crimea, that's the end of the dollar. It's not the end of the dollar. It's a straw in the wind. It's a step in the direction of the decline of the dollar. I agree with that. But the thing that's going to be the end of the dollar is the thing you won't see coming. The things that we understand, kind of, you know, at the margin they have some impact, but they don't really hurt us. It's the thing you don't see coming. And when it comes, it'll happen quickly and it'll be too late. People say, oh, I'll go buy gold then. You may not be able to get the gold. I mean, you look at what's happening. You know, why did gold go down in 2013? Well, the dealers, the major dealers, depleted the GLD warehouse. The GLD is the gold ETF. They have physical gold, but they took 500 tons of gold out of the GLD warehouse and sent it to China. And the reason I know that is because I was in Switzerland meeting with the refiners. And because the gold in the GLD warehouse, they were these 400-ounce 999 bars. The Chinese don't want those. The Chinese want 1 kilo 49 bars. And so you've got to take the 400-ounce bars, melt them down, purify them, and turn them into 1 kilo bars and sent them to China. Well, I actually met with the guy who's doing that, the guy who runs the biggest refinery in Switzerland. He said that's exactly what's going on. He's working triple shifts around the clock with a highly automated factory, and he's producing 20 tons of gold a week, and he said half of that, or 10 tons a week, is going to China. So that's 500 tons right there. Now, here's the point. When gold goes from the GLD warehouse to China, there's no change in the total supply, but you reduce the floating supply. The floating supply is the gold that's available for leasing, available for leverage, available for unallocated forward sales. That's the gold that gets turned into 10 times the amount in paper that keeps the price down. So that's the floating supply. But when it goes to China, it's not in the floating supply anymore because the Chinese bury it. That won't see the light of day probably for 300 years. And so what's happening is one of the reasons gold's been doing well this year, and I said this in late 2013, is because the technical setup is fabulous. Because you take the gold out from under the bottom of the inverted pyramid, you have to reduce the paper shorts somewhat. There's still leverage, but there's got to be some gold behind it, and that gold's disappearing. So the time to get the gold is now, because when the crunch comes, you literally might not be able to get it. It'll all be in central bank vaults or strong hands.
Excellent, excellent. Listen, Jim, I know you're a busy guy and you've got a dash. I really appreciate the wise words. Really look forward to reading the book. Again, that is the Death of Money, and by Jim Rickards. Again, I definitely recommend folks read that. If you haven't read Currency Wars, definitely start with that. Currency Wars, really fantastic read, and really appreciate the insight.
Good. Thank you, Simon.
Okay.